Hi, good day all. Welcome to B2C Tutorials. My name is Bernard, and I'll be taking you through investment appraisal, also known as the capital budgeting. First and foremost, what is capital budgeting? It's the process of evaluating and selecting a long-term investment that are consistent with the firm's goal of maximizing the owner's wealth. So it is a process whereby you are looking at how to tell the impact of the investment you want to undertake that goes beyond 1 year. You want to interpret it and then choose that type of investment. So you can have two investments and then you use the capital budgeting to assess which of the two investments you want to undertake. And then you should have in mind that you are doing this in order for you to be able to achieve the firm's goal, that is maximizing the owner's wealth. The owner is someone who has contributed resources to have the firm running. Okay. Then we have what we call capital expenditure. These are amounts of money that you spend and then you'll be expecting to receive some benefit within or that exceeds a period of 1 year. So capital expenditure is looking at benefit after 1 year, but then operating expenditure is looking at benefits within 1 year. That is the difference between capital expenditure. So the money you spend or the investment you undertake, and then you are expecting to receive some benefit after 1 year, and that is what we call the capital expenditure. But then the operating, the money you spend, and then you expect to receive some benefit within that same year, and that's operating. There are some 5 steps in capital budgeting process. One is the proposal generation. So proposal for new investment projects are made at all levels within a business organization and are reviewed by the financial personnel. So we are looking at proposing the idea that you have. Then you review and analyze these proposals. Then you take a decision because this proposal might be a lot. So after reviewing them, you now select the best that would suit you, and then you take a decision. So when you take a decision, you now implement the decision you had taken, and then begin to follow up by monitoring the results after the implementation. Okay. There are types of capital investment decision that one might undertake. And that's as you want to invest in another firm, you want to introduce a new product, that is another investment. You want to engage in a longer term project, and then you want to acquire or replace an asset of the firm that you have. And then also you want to do some exploitation, that is investing in mining companies or begin to mine yourself as a firm. Now, we have some methods in which we use to appraise this investment. There are methods that are used to appraise this investment. Another name is called the capital budgeting techniques. Capital budgeting techniques. So this capital budgeting techniques are the methods we would use to appraise this type of investment we want to undertake. And one is the payback method, the discounted payback method, the accounting rate of return, the net present value, profitability index, and then internal rate of return. So all these are used. Some are widely used, others are seen as laggards that are not being used as the others have been used. An example is that the accounting rate of return is not widely used, but then it is acceptable for decision making. And then also the profitability index. These are just not widely used, but then they are used too. Okay, so having said that, let's look at the payback period, a brief description about it. You know, one approach might be to see how quick you can get back your money. So if I invest 10,000, I'm looking at what year would I begin to recoup the money? You know, once you invest, you begin to plan the inflows that will come in. So year one, you expect some inflow. Year two, you expect some inflow. This inflows that you are budgeting or expecting to come in after you invest, you are looking at what year would you fully recover the amount of money that you invested. So if I invested 10,000 in year zero, year one, I budget to receive 2,000, year two, 3,000, year four, 5,000, year three, 5,000, sorry. So year one, 2,000, year two, 3,000, year three, 5,000. That means that at the end of year three, I would recoup the 10,000 I invested in the business. And that is what we call the payback period. So we are looking at the period in which you'd get back everything that you invested. That is what we call the payback period. So if I have two investments to undertake, the payback period says that accept the one with a shorter period payback. That is the decision rule. Accept the project with shorter payback period. Okay. And then we come to some advantages. It is simple to calculate and understand. Shorter payback period involves less risk than the longer payback period. It can be used as a screening device as a first stage in eliminating obviously inappropriate projects prior to more detailed evaluation. So if I want to quickly take a decision on that, we can on an investment, I can actually use the payback period before I begin to use the NPVs and co. It can also be used when there is a capital rationing situation to identify those projects which generate additional cash for investment quickly. Some disadvantages are that it does not consider time value of money. You know, the future cash flow that I said I'll receive in year three, anything can happen. There can be an inflation. There can be a risk that I will not even get it. And then also, there are certain things that we say that would affect the money that we would have to receive. That is what we call time value. We are looking at the risk. We are looking at the inflation. We are looking at the time involved. So if money that I receive in 2 years' time, I can't actually bring it to this period by discounting it, and then I am assuming my payback period might be wrong, because what 5,000 could do now for me in 10 years time or in the 3 years time, the 5,000 Ghana cedis cannot do same. So time passed where we could spend just 100 cedis in getting one full petrol tank in our car. Now we can't use that. So that is the time value, that payback period is not considering. It also doesn't consider the cash flows after the payback period. So after year three, the amount of money that we'll be expecting to receive, maybe they are huge and that you would ignore the project, but then payback period does not consider this amount of money. And then we come to the accounting rate of return. It's basically the average annual profit. That is the inflows that are coming in. You find the average and you divide it by the average investment. That is your initial outlay plus some scrap values. You find the average of that and multiply by 100%. And the decision rule for the accounting rate of return is that accept a project if the average accounting return you computed for is higher than the target average accounting. So the company had told you that we are looking for 20% average accounting return. And then when we did our computation by looking for the average profit over the average investment multiplied by 100, we realized that we are getting something higher than what the company had assumed we are looking for. Then you see you have to accept it. But then if it is vice versa, what we calculated for is lesser than that, then we reject the project as well. Okay. It also has its advantages and disadvantages, which we'll talk later. We have the net present value. The net present value is basically the total present value that you have calculated for minus the initial investment you spent. So all the present value, that is discounting your future value to today, and then taking the initial outlay from it. Whatever is left is what we call your net present value. So we'll take a question on that and I'll briefly explain that. The project says that, the decision rule says that accept any net present value that is greater than 0, and then reject any net present value that is lesser than 0. And then if your net present value is equal to 0, it is the decision of the firm to either accept the project or reject the project. So that one is not certain. If after computing your total present value and you less your initial outlay from them and you have 0, it is your decision to whether accept the project or reject the project. But then if it is lesser than 0, reject it. If it is more than 0, accept it. But if it is equal to 0, you would have to either accept it or reject it. That is your decision to undertake. And then we have the profitability index. That is the present value of your cash flow divided by your initial outlays. So the total present value that you would compute for, just divide it by your initial outlay. This time around, will not be less than it. And then we have the internal rate of return. The internal rate of return deals with a formula that says that your discounted factor plus bracket open, the net present value for the discounted factor given in the question, divided by the net present value that it was given, the discounted factor was given you, minus an assumed net present value with a different discounted factor, bracket open, plus bracket open, the assumed discounted factor minus the exact discounted factor given you in the question, or the discounted rate given you in the question, all multiplied by 100%. So I'll take a question with you and then you begin to appreciate it. So these are a few things I wanted to introduce you to. If you want us to go deeper, you need to sign up with B2C Tutorials, and then we will take you deeper into it. Now, having said that, it's a question that I want to take with you today, and then we discuss one or two things in the question. All right. So this is the question. It says that Oja Chrome Manufacturing Company is purchasing a production facility at a cost of 21 million Ghana cedis. The firm expects the project to generate an annual cash flow of 7 million over the 5 years. Its cost of capital is 18%. Now, another name of cost of capital is the rate. Another name of cost of capital is the discount rate, interest rate, or cost of capital. That is what we refer to that. Now, it says note, present worked solutions and circle the correct answer from the list of the possible answers. So this is just a guide as to solve it. The first question is, what is the payback period for this project? The next question is asking you, what is the discounted payback period for this project? The third is, what is the net present value of this project? And then the last but not the least, it asks you to look out for the internal rate of return on this project. Okay. Having said that, let's go through them one after the other. Now, it's actually the payback for this period. So you quickly need to draw your table to know the number of years, to know your inflows or the cash flows, and then you do what we call the cumulative to be able to determine your payback period. Okay, so this is it. This is it. So we draw our table. We have the number of years. We have our cash flow. It says that at year 0, you are investing 21 million Ghana cedis. And then for the 5 years, you are expecting to receive 7 million each year. So we have this amount of money to be receiving every year. But then the question says that, what is the payback period? What is the payback period? We want to know at what year would you exactly pay back the 21 million? And that would give us the cumulative cash flow. So when you do the cumulative cash flow, this is how it works. You first list the amount you spend. Then you ask yourself, in year 1, if you receive 7 million, what is left for you to receive again? It is the 21 million that you owe. And then you pay the person 7 million. How much do you owe the person again? You owe the person 14 million. Then in the next year, which is year 2, you are expecting to receive 7 million. If you pay the 7 million, what is left again for you is another 7 million. And then in the third year, you also invest 7 million. You also receive 7 million, and then you had 7 million to pay. So when you pay off the 7 million, you have nothing again in this year. Okay. So it follows a formula. It follows a formula which says that the year before full recovery plus the outstanding cash flow, which is this outstanding amount of money for that year before full recovery. This is the year before full recovery, and this is the outstanding cash flow for the year before full recovery. Then this is the cash flow for the year in which you are going to recover. It is in this year that you recover that amount of money. So the 7 million here stands for the year before full recovery, the cash flow, divided by the year in which you are going to fully recover cash flow, plus the year before full recovery. And then when you do your plus or minus, 7 million over 7 million is 1 million. One plus the 2 would give you 3 years. So the payback period for this question will be 3 years. Will be 3 years. Okay. Then you come down to the next question. That says the discounted payback period. Now, when we say discounted payback period, we need to find what we call the discount amount. How do we find this discount amount? I would write it here. The discount amount is basically your future value, that is your inflows, multiplied by what we call the discounted factor. What is the discounted factor? It is 1 out of 1 plus the cost of capital or the rate, bracket close, raised to the power the number of years, which is n. So an example, I want to pick the first one with you. The future value was 7 million. The future value was 7 million. So briefly write your 7 million. Multiply by 1 out of 1 plus the rate given us was 18%, according to the cost of capital in the question, was 18%. So the R is rate and the N is the number of year. That is the year in which you are in. So I am doing for the first year to find the future value, present value. And the first year, 7 million divided by this. The number of year is what? Year 1. So I would raise to the power 1. Now, if you use your calculator, this is the expected answer you are supposed to arrive at. Now, if you are doing for year 2, it's the same procedure. Then this one changes to 2 because you are doing for year 2, and that would result in this answer. Same for year 3. Now, when you do this, you are finding what we call the discounted amount, or you are finding what we call the present value. So another name for the discounted amount is also referred to as the present value. When you do that, you have found the discounted amount or the present value. We use the discounted amount for our discounted payback period. And so we'll come and do cumulative discounted amount. Now, the cumulative discounted amount is that I am investing 221 million. And the first year, I am saying my discounted amount is 5,932,203.39. If I pay this amount to the person, I'll be left with 15,067,796.61. When I pay the year 2's amount again, I'll be left with 40,505.60. Then the next one, when I pay the 4,260,416.11 from this amount of money, I would have 5,780,089.49 left to pay. Okay, so in the 4th year, I can actually see 3,610,000 and I'm owing 5 million. So I can pay the 3 million, right? If I pay the 3 million from it, I'll be left with 2,169,567.37. But then looking at the fifth year, the amount of money I am receiving is more than what I am owing. That is where the formula applies. So if the amount of money I am expecting to receive is more than what I am owing, I apply the year before full recovery, which says that this is the year before I can fully recover. This is the amount of money that I'm owing or that is outstanding for me to fully recover, divided by the cash flow that is outstanding for me to pay. Okay, so it is going to be this fourth year plus this 2,169,567.37 divided by 30,59,764.51. And that would give me my discounted payback period. So when we come to the discounted payback period, 4 years plus this 2,169,567.37 divided by 3,059,764.51. When you punch that on your calculator, you are supposed to get 4.71 years. 4.71 years. So taking you back to the solution or the possible answers, we see 4.7 here, and that is our final answer for the discounted payback period. So you need to find a discounted amount. You need to find a cumulative discounted amount, and then you'd apply the formula to arrive at that figure. Okay, having said that, the question says the net present value. So if you look at the table very well, the sum of all the present value, which is referred to as the total, is the total present value. So I told you another name for the discounted amount is the pay, is the present value. So if I add all this here, I'm supposed to get 21,890,197.15. You can ignore the decimals when you're working. You can ignore the decimals because it will take much of your time. But then for accuracy, you can also include the decimals when you're working. Now, adding them is my total present value. And I said that to find the net present value, it is your total present value minus your initial outlay. So this is your initial outlay, the amount of money you spent at the beginning of the year, the 21 million. So if I take this 21 million from my total present value of 21,890,197.15 will give me my net present value. And this is it. This is it. This is it. Okay. So after doing this, our net present value is 890,197.15. So when we get to our question, our final answer, it is this figure because the decimal becomes insignificant. It can't be added onto it. So 890,197. Now, the major headache goes to the internal rate of return. And I said that the internal rate of return, we have been given a cost of capital of 18%, which we have found the discounted amount already. Now, we need to select something, a rate bigger than the 18% to ensure that we get a negative net present value. So you can select from 19% and above, but then sometimes you need to give an interval. So you can say 25%, you can say 20%, you can say 27%, you can use 30%, so you can even use 100%, but it wouldn't make sense if you use 100%. So it is between the 9, is from 19 to say 99%. You select something higher than that. That one will not be given you in the question. So you need to assume that. So if you look at the question, the solution, I assumed a 30%. Any percentage you use will still arrive at the same answer. So I assumed a 30%. And then, for the 18%, we have already dealt with the discounted amount. So you have to do for the 30% to assume for the discounted amount. So if you hadn't forgotten how to do for the discounted amount from the initial, that is the future value multiplied by 1 over 1 plus r raised to the power n, you realize that if I do same for 7 million using 30%, I'll be getting this figure. So I would have the 7 million. So let me put it as 7m multiplied by 1 over 1 plus 30% raised to the power year 1 raised to the power year 1. So you do that on your calculator. Then if it is for year 2, you just clean the 1 and then put in 2. If it is for year 3, you clean the 2, you put in 3. If it's for year 4, you clean the 3, put in 4, so that you'll be getting your discounted amount. Now, when you get the discounted amount, the target is for you to look for the net present value. And because we know how to find the net present value from our previous questions, we said that total present value first. So you realize that for the 18%, the present value was 890,197.15. So if we do same for this, when we sum all the present value for the 30%, we have 17,048,988.27. Then this is our initial outlay or initial cost. So you call it initial cost or initial outlay. So this initial cost or initial outlay is 21 million for the 2 projects. Now you now less your initial cost or investment from this, and then you realize that for the 18%, which is what was given us in the question, was a positive. But then what we actually computed for happens to be a negative figure. And that is what we call the NPV1 and then NPV2. So if you substitute it into this formula, the A always represents the percentage given you in the question. The NPV1 is the NPV of the A that you were given in the question. All over the NPV1 over the NPV2. The NPV2 is this figure. And it's a negative figure. Already the formula is a negative. So if I bring in a negative again, when I'm doing it, it tends to become a positive. Open brackets, the one you assumed, the 30% that you assumed, minus the 18% given you in the question, and then we are good to go. So you see NPV2 is negative. NPV1 is a positive figure, which is always going to be positive according to the question given you. And then also you would have the A and B given you in the question. So when you substitute it into the formula, the 18% plus the 890, that is the present value, the net present value, all over this plus. The reason why we put in a plus here is that, just like I mentioned, the formula says a negative, and already you are bringing in a negative NPV. So negative would be fighting against negative, which would give you a positive. Then you'd multiply that by the subtraction of 30% minus 18. Now, when you do this clearly and you do it well, you would have the 20%. Even if you use a different rate, you still get the 20%. So that is for question number 33. And then the final answer is a 20%. It's a 20%. It was going to give you 20 points on decimals, but then if you ignore that, if you look at the decimals and then you run on to the nearest whole number, you would not get any significant value, and then you'd be having the 20%. Okay, so that is the end of this question. The focus is just the computation and not the theory aspect of this question. So this brings us to the end of this question. There's another question I'd want us to look at again right here. But then before then, let us take a quick break and then come back again to look at it as well. So welcome back from the break. We want to take this question again. It looks easier, but then it needs some attention and time. It says, use the following data to answer question 12 to 15. High Flyer PLC has 2 possible projects to consider. It cannot do both. They are mutually exclusive. That is, they don't have anything in common. So the cash flows are as follows. point in time, 9, yearly intervals. Then we have project A, project B. So the number of years start from 0 to 4. So for project 1, we would spend 420 cedis or whatsoever currency as our investment. And then for project B, we'll be spending 100 cedis for that project. So if they were mutually inclusive, we would have been spending the same amount of money to undertake the project. But because they are exclusive and different projects, we are looking at different amount of money to invest to undertake the project. So these are the cash flows that are expected to come in. For project B, year 1, year 2, then they end it. But for project A, same inflows to the 4th year. Okay, high flyer cost of capital per is 12%. Is 12%. Assume unlimited funds. These are the only cash flows associated with the project. The directors of the company have a policy of accepting only projects that can recoup the initial investment within 1 year. Within 1 year. So they are looking at recouping the investment within 1 year. So they would ask you a question and then you need to tell us. So it says, what is the payback period for the project A and B based on the decision, on the payback decision rule? Which of the two projects should be accepted? The payback, the rule here says that accept the project within 1 year. So if you compute the two and then one is within 1 year, then you tell us to recoup it within 1 year. Now, just like we know, this is just a payback, a normal payback. So we find our project, we do our cumulative, we do our project, we do our cumulative, and then we apply the formula in solving them. Okay, so this is it. Project A, it's cumulative. Project B, it's cumulative. So if I invest 420 and in year 1, I am recouping that 150,000 out of it, I'll be left with 270,000 to recoup. Then in year 2, if I'm recouping 150 out of the 270, I'll be left with 120 to recoup. But in year 3, we realize that my cash flow is more than how much I'm supposed to recoup. So the formula says the year before full recovery, the outstanding, which is the 120, divided by the cash flow for the year for full recovery. So this is the cash flow for full recovery, 150. So it's 2.8 when they are done. So the year before full recovery is 2 years. The cash flow for that period is 120, and the cash flow for the next year, which you are going to fully recover, is 150. If you do so, you're getting a 2.8 years. But then if you do for project B, 100,000 year 1, I am getting 75,000. Year 2, I am getting something above what is left for me. So I do my 1 year before full recovery, which is year 1, plus 250,000 over 75,000. After doing that on your calculator, you get 1.33 years. And then you can see that this is not within 1 year. Neither is this within 1 year. So this is 1 year and some months in the following year. But then the project's saying that within 1 year. So what will be the rule? After doing the computation and then writing out payback period for year 1 is 2.8, 2.8, and then project B is 1.13. Then you write your rule by saying that reject it because none of the project is paying within 1 year as it was stated. So reject both project A and project B. So I made a mistake here by writing accept project B. So it's for you to reject both projects. That is the rule. Project A and project B sorry, goes beyond a year. Therefore, rejects both projects. full stop, and you're done. And the next aspect of the question says we should find a discounted payback period for both project A and B. And just like we know, we need to determine our discounted amount. We need to determine our discounted amount, and we'll do our discounted cumulative for A. Then for B, we do the discounted amount and then do the discounted cumulative for B. So you know how to do the discounted amount, just like you know, it is 1 over the 1 plus the R raised to the power n multiplied by the future value. That is the cash flows. So for the first one, it would have been 1 over, it was 12%, right? So 1 plus 12%. Please, some of you will be converting the 12% into decimals. If you don't know how to do it, don't convert it. Raised to the power 1, because we are doing for year 1, multiply by 150,000. And you do same for year 2, over and over and over again. So you get to year 4. So these are the result after finding the discounted factor and the discounted amount. These are the results. And we said that the addition of all of these will give us the total present value. Would give us the total present value. And the addition of all would also give us the total present value. Reasons why I do the total present value is because looking at the latter part of the question, which says that calculate the net present value for project A and B, and on the net present value decision, which of the two projects would you recommend for the investment? That will be your decision to take after you do that. So both would be giving you a positive return, because looking at it, see, this is 35,602.4. This is 26,753.83. So both net present values are giving you positive. So you can accept both projects. Just that project A has a higher net present value compared to project B. So you can tell them to accept both because they are both positive. But then you can further go ahead and tell them that they should consider project A because it has a higher net present value than this. So they can accept both, but then go ahead to accept project A, which has a higher net present value compared to project B. So just like we did for the discounted for the previous question, you realize that the discounted amount, 420, if I take the discounted amount from it, this is my difference. Taking the next discounted amount from it, this is it. So when we go to the third year, we realize that we have some 59,725.31 for project A to pay. Meanwhile, we have 95,327.71 to use to offset it. So the formula still holds. The third year plus the 59,000 divided by 95,327.71, and then we'll find the discounted payback for project A. Then we come to project B. I had 59,000, and then this was 33,000. So year 1, which is the year before full recovery, it's outstanding divided by the amount. So I didn't do this one intentionally because I would expect students to do that and then share their final answer if they want to, or test their knowledge on that. So this brings us to the end of our discussion for today. If you are really interested in joining us to study and then solve more questions, you can reach out to us on any of the numbers that are readily available. So the 05076527761, you can text or call us. Then we have the 05399484466. You can text or call us. Then we have the 05083523354. You can text or call us. You can also follow us on LinkedIn as B2C Consult, and then you can also follow us on TikTok as B2C Tutorials, YouTube as B2C Tutorials. Kindly subscribe and hit on the notification button. Anytime you upload a video, you'll be prompted and then you go through. If you also want to send us an email, you use classes.onlinezm@gmail.com. So we are reachable anytime, any day to assist student with relation to any question that comes up. Thank you, and then enjoy your time. with B2C Tutorials. Have a lovely day and bye-bye.